I'm delighted to host a Red Cloud webinar on lithium today, and we're going to hear from Sigma Lithium's co-chairperson and CEO, Anna Cabral-Gardner. Now, during today's webinar, she will provide an overview and outlook, and then we'll take your questions. We'll get to your questions as many as we can. Please type them into the chat box when you can. So before we kick things off, first we need to discuss the fine print. During the Sigma Lithium webinar, forward-looking statements may be made. I would direct listeners to the forward-looking statements outlined on pages 2 and 3 of their corporate presentation that can be found on the company's website, sigmalithiumresources.com. For Red Cloud Securities, I'd highlight this webinar is for information purposes only. It should not be considered a solicitation or recommendation to buy or sell securities, and we note that the call does not consider the particular situation or needs of individual investors. Participants should really rely on their own investigation and seek their own professional advice before investing. So please see our most recent research located on the Red Cloud website for specific disclosures on Sigma Lithium. Now, this week, Red Cloud published a hard rock lithium guide to, published a report this week. It's a guide to hard rock lithium. Now, Sigma Lithium was highlighted as a top pick in the report, and we noted that investors tend to favor the hard rock lithium companies. They are typically quicker to get into production, and that's never been more clear than Sigma's Grota do Cirilo project, whose initial resource was published as recently as 2018. And while we have seen a slight pullback in lithium carbonate and lithium hydroxide prices, importantly, spodumene concentrate prices continue to fetch top dollar. And that's good news for Sigma, as it's due to embark on its initial production within the next month or so. So further production expansions are also anticipated to be funded from existing cash and cash flow. Sigma has a world-class asset and potential to become the world's 4th largest producer with 2nd lowest cost and 3rd highest grade. So with that, I now turn it over to Anna to update the audience on the company. Anna.
Thank you, David. Thanks for hosting me. So I will share my presentation. Can you see the screen, David?
Yep, I see it perfectly.
Yeah, and this is sort of how we would like to introduce Sigma. We've developed this asset for 6 years very consistently as a force for good. In other words, we've been driving environmental and social sustainability in the battery materials supply chain for electric vehicles. At that, just a quick on the company. I mean, I was able to deliver this mission because we've been very fortunate to have the support of very large institutional shareholders and private shareholders at that. So BlackRock has been a very big supporter of the company since we went public in 2018. And then I'm also a part of the financial sponsor, which is A10, the A10 Impact Fund, that essentially purchased the co-control of Sigma and has developed this company for now going into the 7th year consistently and steadily. And in this process, we were able to have other ESG minded and impact investors related impact investors with the same mindset join us on this crusade. So we've been fortunate to count on a very, very stable shareholder base as we grew the business steadily and very expeditiously since IPO. We've been widely covered in Canada, as you can see the list of research analysts, and we are very fortunate to have basically arrived at the moment when we are about to produce. I mean, we developed this project over the last 6 years with the aim of getting to cash flow, getting to production, and we got here. Sigma will be the first new hard rock lithium producer to deliver lithium materials in commercial scale since Pilbara initiated its operations in 2018. So for 5 years, the industry hasn't had a new large commercial scale hard rock producer. And at that, we'll start quite big. I mean, we will start as the 6th largest overall lithium producer in the world, delivering 277,000 tons of lithium concentrate battery grade, which is equivalent to 37,000 tons LCE of material. At that rate, the company has about 20 years of project life. Immediately thereafter, as we already announced in December, we are embarking on a tripling. We're going to triple the production capacity. It's a pretty simple, straightforward expansion where we're just building 2 more line trains, and then we become the 4th largest lithium producer overall in the world at 766,000 tons of material. And again, no surprises there. This is lithium mining in superlatives, just the way you find in the 2 largest mining areas in the world, Brazil and Australia. So it's the same phenomenon as iron ore. Large scale mining in superlatives, it's there, right? More importantly, the quality of the lithium concentrate that we produce is also special. I mean, this material brings up to 30% additional productivity downstream, resulting from high purity, coarseness of the granulars, the granular product produced, in the high grade. So that means that each ton goes 30% further. So that's free productivity to the client, which allows us to entrench ourselves in our customer base in an irretrievable manner. So we're here to stay. Once you couple that with the fact that we've been a force on environmental sustainability in the supply chain. This is why we're such darlings of the downstream, because we're delivering a better material that brings more productivity, and we're delivering a more sustainable material at that, right? In great part, this processing method and the specialty of our material is also what helps us drive to be lowest cost producer. We're in the lowest production cost quartile. We're second in costs only to the Greenbushes operation, Talison operation. Similar circumstances, very, very good mineralogy, high purity, high grade, therefore lower processing costs. And that's what drives the industry. So the low cost for Sigma actually were the key to our survival of the bloodbath that we lived through in the down cycle of 2018 until 2020. So this is why we actually made it here first and unscathed. But more importantly, going forward, it also what makes this business model resilient, because at $523 a ton delivered in China, we have a business model resilience that's pretty hard to replicate because it stands in any pricing environment. But more importantly, makes Sigma a very attractive, integratable proposition for any of our potential partners and customers downstream, right? I just talked, about the expansion. I want to highlight the fact that we're fully funded to effect that expansion. We got a strong balance sheet. We just borrowed $100 million from one of our shareholders. I mean, clearly, as we discussed earlier, we got a very well capitalized, robust base of permanent capital in the form of our shareholders that have been very happy as shareholders as far as us delivering on our environmental and social sustainability metrics and returns. So the shareholders are here ready to support us and in our expansion ambitions, as they just did in December, where they lent $100 million. It was our first debt ever in the company to announce the expansion fully funded. This page, just a quick recap on our numbers. Sigma, the total NPV, if we assume an average price of about $3,900, which is very different than the current market price, has an NPV of $15 billion. So there's quite a lot of room to go. The project has got 13 years of operating life, running on 3 trains, meaning at triple capacity. At current phase 1 capacity is over 20 years. And on average, running on 3 trains, we would generate $1.8 billion of average annual free cash flow. Again, large scale, phase 1, 270, phase 2, 766. So all of this is supported by pretty sizable mineral resource 43101. When you add up M&I and I, we are now 85.6 million tons of spodumene of extreme purity and extreme quality, very high grade, average grade 1.4%. This page, it's into the operation, right? Why are we so successful in achieving what we achieved? Because we do not have to deploy any capex outside of the borders of our project. We are located in Minas Gerais, which is the Western Australia of Brazil. I mean, a good portion of the world's iron ore comes from here. We've got roads, ports, transmission lines, water, hydropower, abundant and cheap. So it's a pretty friendly and easy jurisdiction to produce. And that's what we're doing. I mean, more importantly, Brazil is a neutral jurisdiction that sells to the world. So we can sell to the United States, to Europe, to China, easy access through the Atlantic routes. So very friendly and very strategically located mining jurisdiction, right? This slide is just a quick recap on our business model, right? What is it that we do, and why is our business model so resilient? How did we manage to cross through the downstream, through the down cycle, unscathed, and get to this moment in such a strong competitive position? Because we are entrenched in the downstream. In which way?
Anna,
well, yeah.
Anna, sorry, I don't want to interrupt here, but people are not seeing the screens turn online. So
The screen is fixed, or what's happening?
I think they're still seeing the title screen.
Oh, okay. So I don't, let me just go back to this 1 second. So maybe I think it's probably safer if we put the, I wouldn't know how to do that. So it would be, you would probably safer if you put that presentation you got, because I wouldn't know how to do this from the screen share. Yeah. So why don't we, so should I navigate here? Yeah, next. Perfect.
Okay.
So let me do that. Okay, so I was here. I don't think anyone saw here. This is what I was just talking to when we were saying that this is a pretty straightforward jurisdiction, and all the infrastructure is there. These pictures are real. We got the river, the hydropower, the transmission lines, the highway. So pretty straightforward as far as production jurisdiction, very friendly. A good portion of the world's iron ores come from here. So it's the Western Australia of Brazil. We just talked about it. This is where I stopped. This is kind of what we do. We're very entrenched into the downstream because of our business model. In other words, we have the mine. I mean, lithium is two operations, right? It's a mining operation and it's a processing operation. And our environmental sustainability comes from the fact that we really focus on trying to get this processing operation to be as close as possible to zero. If anything, almost zero, so that we would then be able to tackle the carbon and the emissions on the mine, and therefore reach zero carbon, low carbon overall. More importantly, because we chose an existing technology called dense media separation that's widely used in Alchem, Galaxy, Mount Cattlin, for example, and we perfected it. I mean, perfected meaning we automated it and we digitalized it. I mean, I could run this plant from like an iPad here, for example. We were able to achieve a better yield on recovering using dense media separation. Clearly, that's obviously also a function of the mineralogy of our product. In other words, because the mineralogy of our product, let me see if I can get to this, right? The mineralogy of our product is unique in terms of high crystals in the formation. We were able to deliver materials that were, essentially easily processed through this dense media separation plant. So you see the picture here, how unique is our product. And so as a result, I mean, we were able to achieve higher yield and lower cost. So what it does, and I'm gonna flip-flop on the screen so that we can go through this in sequence. So what this does is essentially allow us to bypass the upstream, the midstream altogether, and have a business model where we basically go straight into the battery makers or the automakers and transact material with them, and then they, with their leverage, go to the chemical industry to commission the refining with a lot more leverage than us if we were to negotiate with the chemical industry. What does it do? Is a significant business change, because the juice out of the chemical industry is then captured partly by the downstream battery maker and partly shared with Sigma, using the leverage the downstream battery maker has with that segment of the industry, as opposed to Sigma becoming a hostage of the refining industry and having to negotiate price on a zero-sum basis with the refiners. So this was the disruption in the business model that we brought into the industry back in 2019, when we were still partners with the Japanese trading company. And it was a breakthrough because it was a manner for us to enable batteries to cost less for the downstream. This is why we became so entrenched and so close to the downstream. It was this disruption of the business model. We saw the industry upside down. And that's a benefit of having us, at the helm of an industry, not being hostages to the existing business model, because we're all a bunch of outsiders. So when you come as an outsider, you look at it as a white sheet of paper. Let's just redesign this to make it better from a business perspective, to lower the cost of the batteries, ultimately because we saw EVs as a volume business, right? So we talked about this page. So here is the growth in a graphic denomination. In other words, phase one. So we start with 270,000 tons, and then we triple into phase three straight away. So instead of doubling, which was the original concept in 2019-20, by the end of 2020, it became clear that the tsunami of demand coming from Europe would mean that we would have the ability, because of the environmental sustainability and because of this, extra efficiency into our product, to sell all of our product before anyone else in the industry, because the sustainability and the efficiency are not priced. Those are what we call value in use for the customer, that come in as free attributes. We hope that in a more mature market, this would eventually be priced like you see in copper concentrate, alumina, even iron ore prices efficiency. But lithium is too incipient. So clearly for us, we had a pricing power and a competitive advantage because these attributes were being transferred free to the downstream. So this picture actually shows what our plants delivered. In other words, we're now about to produce, weeks away from delivering concentrate on the ground, first week of April. And when you look at light gray, it's the current production delivered in 22 by the incumbents, by the producers, right? So our light green is phase one. So at phase one, we're going to be at 37,000 tons. So the sixth largest producer in the world, which is something that makes us really proud that we got here sustainably, with environmental and social sustainability first, right? And then the dark gray, it's the expansion plans of the incumbents, which actually shows something very interesting. If you look at the bottom players are those that are currently large, but they cannot keep up with the super majors. Why is that? because they do not have a large resource base to draw from. Sigma, though, because we got a large resource base to draw from, we can keep up with the super majors. So as we triple, we will then go from 6th to 4th largest producer in the world. In other words, we are going to grow in a market where the super majors grow and capture the lion's share of the industry. So we're going to be joining this club of super majors hopefully next year as we become a what we call triple line train producer, 4th largest producer in the world. So we grow, and then we grow more by delivering production. So it's a very relevant company in the lithium industry. And as such, I mean, we believe we could be a force for good. So the following slide is a segue to the previous one, but then what's happening though? I mean, why are we, valued where we are compared to the producers? Well, because they're not producing it. What happens here is a clear picture of what we heard from investors in a bank conference in Florida as the skepticism gap. Just give you guys a few numbers, and I've known Talbot since then. When we went public in 2018, there were 290 publicly traded companies in the lithium business between Australia and Canada. That's a lot of juniors, right? A down cycle came, bloodbath. Anyway, there were 4 companies that survived it, fully funded, in construction, and those are the companies in yellow. Of the 4, we're the first ones to cross the finish line, to produce final product, right? So think about the mortality rate of this business. 290, 5 years later, only 1, right? So huge mortality rate. So that drove the skepticism premium, meaning when you look at the green, it's a winner takes all. Producers are grabbing all the value because when investors want to play lithium, they just hold producers. So what we're hoping to achieve when we join the club of producers within a few weeks is a repricing of the company. In other words, it's pretty clear when you look at the bowls show our current production, right? Here, the 37,000 tons phase 1. It's kind of the size of Alchem and Livent. So, I mean, we don't see any reason why we wouldn't, march towards that kind of value creation once we put that material on a ship, April sometime, right? Then the good thing about Sigma, based on the previous slide, is that we don't stop there because we got this very large resource base, reserve base at that to draw from. We're going to be building the tripling, the expansion. And at that, we're going to continue to march on the growth as we continue to hit the construction milestones in that project. So I was actually criticized today by being a divorced woman of 2, a mining outsider, therefore not a good CEO. Well, I'm telling what I'm really good at, delivering projects on time and on budget. And I think the survival of the fittest here demonstrates it. So we're going to continue to do, as a private equity investor, what we're excellent at, which is deliver this project for the expansion on time and on budget for next year. So when we talk again next year, we're going to be marching towards Pilbara because that's the next stop for a company that's going to be then delivering 3 line trains of production in this market, right? So we're very excited about joining the producer club because once we're in that ladder, we're going to continue to grow as a company towards achieving the goals. And again, it's execution that matters. This is why the mortality rate is really high. So again, we talked about this number, and here's more on execution. In other words, we delivered this, which is the common infrastructure. This is basically in commissioning. It's built and in commissioning. There's a fantastic video on the web from our commissioning of the crusher. So we're in the process of commissioning the wet plant, which is the dense media separator, this beauty that we can run through this pad from anywhere. With 6 guys on site, we can run the plant digitally, courtesy of Starlink. And then we're going to build 2 more line trains. Again, more of the same, carbon copy of the first one next door. In an industrial site, as you can see, that took us 8 months to prepare. It's an industrial site for a production, and again, ready to go, right? So we're gonna finish commissioning, final inspection, operating permits, and then go. So pretty automatic process as far as Brazil goes. Why? Because we are a case study for the country, for the industry, for just everyone concerned as far as environmental and social sustainability. And here a bit more about the numbers, right? And I like to kind of pause here for quick math. Talk about value, undervalue, overvalued a lot, right? Let me just go to another one here that I like better. Hold on, see if it's here. Not sure though, it's not here. So let me go back to that one. So let's say tomorrow you open the newspapers and you realize the lithium prices have crashed to, let's say, half, right? So tomorrow you woke up, Jesus, is half, right? So what happens? Well, if you look at after-tax earnings, and again, we're assuming here 1/3 of this, so it will be like 1 billion, right? For phase 1. So it would mean that we would have $1 billion of earnings annualized. So at today's valuation, will be valued at 4 times earnings, 4 times PE. That's pretty attractive. So I'm a private equity investor by training. I can't find anything in the private sector, small, to buy a 4 times PE. There's nothing out there. So this is why we're still here for 6 years, and we continue to work towards production, because the value proposition, even for us, the way we allocate our resources, our capital, and our time is unquestionable, right? And this is the 43-101 model and the mathematics of that. It's pretty clear. Next year, it's even more compelling, to a point where I'm getting questions of what are you going to do with all this cash next year? And we do have a good, plan for that. It's obviously moving to intermediate chemicals, technical grade carbonate or lithium sulfate, because we have the ability to deal with the tailings, right? We can actually upcycle and make it zero tailings as well. But again, mathematically, assuming I'm going to take the cash and distribute, right? We're going to be, in theory, when I deliver, we expect when I deliver the phases 2 and 3 on a going concern, 24 to 25, we would be at 2.8 billion of profit, assuming prices fall into half, slashed by 50%, right? That's the number over here, right? So it means that we'll be valued at 2 times earnings, not even 1.5. So it's kind of obvious that this company is due for repricing once we enter production, hopefully, right? And again, I think lastly, just to close this so that we can open for Q&A, and I want to reinforce that the reason why we made the investment in the first place, the reason why we got here with such a stellar dialogue with downstream and such a competitive advantage is because we've always prioritized sustainability when it was not fashionable. So I earned the nickname of hippie CEO. Now I'm going to earn the nickname of divorced outsider CEO, but that's pretty damn good for my investors, so long as I keep on delivering the way I've been delivering. But ultimately, we got here because we took a different approach to the project. We decided, we understood that the customer that buys this car would eventually ask questions about what was in the car, and the questions were very poignant. I mean, do I want to buy a car that takes the diesel out of the streets of Berlin if there's a diesel generator powering the lithium processing plant elsewhere in the world? And I'll tell you, that was the picture in 2018. The lithium processing plants were powered by diesel generators. Really, that was the case. It was that simple to debunk sustainability, right? Tailing dams today, tailing dams are prevailing everywhere. We are zero tailings. So our approach is remarkably different. So it may not matter here But downstream to the customers, to automakers who talk to these customers, that's all they talk about. That's all that matters, because there has to be a consistency between the lithium materials and the value proposition of the car if EVs are to go through 50% uptake, right? That consistency is what is going to take the industry to 100%, to mainstream. And I think here is just a wrap up on where we're going, where we are in commissioning. So we delivered this. We said we're going to start commissioning at Christmas, and we started at Christmas. We finished commissioning of the crusher on time in February. That was after having delivered the construction on time, on budget in December. And then here's the crusher. It's running. There's a beautiful video. This is run of mine. So this is revenues. If we wanted to sell DSO, this would all be balance sheet revenues. But we don't do that, because this becomes 4 times revenues once we add value to it, which will happen in a few weeks' time, right? This is run of mine, DSO. Then here is the crusher. We already have also crushed materials, which is even more valuable than DSO. See the silo is filling, right? You see the material coming down, is running day and night. Again, we don't, because that's not the business. The business to sell the battery grade pre-chemical concentrate, right? Here's the mine. The mine has been running since October. South pit, run of mine, which is the stockpile. So now the DMS, where the magic happens, the Greentech plant, where we are able to extract super high yields, low, basically recirculate the water, dry stack the tailings. With the environmental circuitry, we're able to deliver this sustainable, this green lithium, right? We started commissioning on time in January. We're completing commissioning by the end of March as planned, everything according to plan, and we're going to have first material in April. And then first material in April, we will accrue a shipment, and we are planning to ship first week of May, because we need to accrue volumes to deliver the first boat. Most likely it will be 15,000 tons, 1.5, first boat, first 2 weeks of May off, right? And then we're going to continue to ramp all the way to the end of June, when we're probably going to be hitting steady state by July into steady state commercial production, which is the nameplate capacity for the equivalent of 270,000 tons annual, right? So this is the DMS. You can see the thickener. That's where the magic happens. This is why we're sustainable. We dry stack the tailings. The water gets removed from the material through the belt filters and reinserted back into the plant in a complete recirculation of the water. 100% of the water is reused. And the water we use here is sewage grade water, with piping it 6 kilometers from a river where there's sewage grade water at that, right? This is the scope 2, which is the power. We use clean power. There's a transmission line right here, you see, on site, courtesy of the National Grid of Brazil. And as that, we can choose the clean power mix. Wind, hydro, we chose wind, hydro, solar is a nice mix. We purchase it straight from the grid. An electron on the grid is an electron renewable. So 100% clean power. So the tailings are dry stacked. We're selling the tailings with the product, so it'll be 0 tailings. Because they're dry stacked, I can sell them. They're not a sludge in the tailing dams mixed up with chemicals, unused. 100% of the water gets recirculated. We use a dense media separation plant, so there's no hazardous chemicals, therefore sustainable, no hazardous chemicals, and then 100% clean power, digitalized, right? So that's that. This is Sigma. And I think on social sustainability, and there's quite a lot that I want to talk about on social, but just to start, I have 1,000 people on my team now, and I'm proud to say that 70% are from the region. They were not there. The region is destitute, very poor. These people have migrated out of the region, and we painstakingly recruited these people out of the region throughout Brazil, throughout the world, to bring them back to the region to reconstruct the social fabric. We call it the homecoming program, and it's an enormous success, and that's what made us a case study in social sustainability in the country. Is the way forward to develop entire regions of Brazil using natural resources, mining as a vector, right, as a positive vector to society, right? So that's that. So I would like to thank you all for listening to me today, for joining us to learn about our progress. And David, I mean, the floor is yours, right?
Great. Well, thank you very much, Anna. It was a very informative presentation, as always. You know, you did talk about what happens if con prices get cut in half. Well, if that happens, you're closer to our long-term estimates, which we use to value the stock. So everything's okay. So we are going to kick off the Q&A portion of the webinar right now. Reminder to everybody online, you can type your questions into the chat box. And we already do have a few questions here, Anna. So you are on schedule and on budget for April 2023 production. Now, could you provide some color on how smoothly the ramp up is expected to go, where you might expect any difficulties? Do you need any final permits?
Yeah, no, it's going super well. I think, we are, experiencing a glitch-free ramp up in great part because we allowed ourselves an extra month of cushion, right? So that made a big difference because in a way we were ahead of schedule, and we might surprise and be ahead of schedule again because we built the timetables of an extra month. So, I mean, we were easily able to manage any issues that happened within that month of cushion. We still, with that month of cushion, right? Can you see me? I don't think I can see you for some reason.
Yep.
But you see me, right?
Yeah, I see you fine.
Okay, perfect, fantastic. So the permitting, well, what we need to deliver now is the operating license, which is a pretty straightforward license. It's what we call the fire inspection type license. We actually had the inspection. We received the positive, the favorable approval. So it's it's the easy one, as we call it, for those of you who understand licensing in Brazil. The hurdle one is the LPLI, which is the one that allows you to install, build, commission, produce, deliver material, put it on the ground, right? The operating license is the piece of paper you need to ship material, and it relies on fire inspections and a bunch of inspections that took place, and we got a very positive report on that. So we're super thrilled about it. Right?
Good. Okay. And without getting too far ahead of ourselves, how quickly do you think you can roll into phase 2 and 3 production?
Well, we are now, we kicked off the detailed engineering work with Promon and DRA. We were together in DRA's offices, my chief operating officer, Brian Talbot, and I. It's actually a pretty streamlined process because the kickoff had 2 sessions, right? The first one was what we call lessons learned, where we're going to probably do even better, right? We took all the lessons learned from phase 1 construction, and we are applying into phase 2 and 3. So detail engineering is ongoing, and you might remember from phase 1, we do like to spend the time and the money on detail engineering because there's no magic here, David. The reason why we deliver projects on time and on budget is because we build like a major mining company. We invest that money in detail engineering so that when we make the final investment decision, we make the final investment decision in a quoted CapEx by suppliers, and we add that pre-purchase the equipment, the long lead item equipment necessary for the construction, and we are able to work with a level of detailing engineering where we are in the no surprise territory. So that from there is what you all witnessed in phase 1, is a bullet train to completion with no or very little deviations to budget within what we call the budget cushion of 15%, 15.15, right? So the business logic of doing detail engineering and spending the money on engineering and purchasing long lead items and depositing towards long lead items, it's been validated by our success in crossing the finish line first. So we're just going to basically replicate that, that model and that strategy into phases 2 and 3. So we're pretty confident. That's why we're so relaxed about it. So we're hoping to make final investment decision in the summer, like in July. And again, bullet train to construction, which again, the difference this time, as I showed you on the schematics, is that we do not have to do industrial site preparation nor common infrastructure construction. So we're literally just building the line trains, which is a 9-month timetable versus a 15 to 16-month timetable as we had originally in phase 1, because the infrastructure is done. So we're just kind of building the line train and the environmental equipment specific to each line train at that, right? The substation is there, everything else is there.
Right. And how much of your phase 1 production is contracted right now? And what's your sort of outlook on pricing with that?
Yeah, well, we contracted very little, and that proved to be very fortunate, right? Because I think everyone, even, very famously now, the government of Canada is catching up with the obvious, right? Which is the value of a company is the availability of lithium units. So a lithium company is valuable the more integratable available units there are. So we never done life of mine contracts. We never done, super long off takes for that reason. Again, guys, we're financial investors. We're pros, right? That's what we do for a living. That's how I get paid. Successfully exiting and investing and delivering investments like this. So from the get-go, we knew that it was a strategic mistake to over-contract production. So we just contracted an amount that's today around 7% of total, which is essentially just enough to make us a viable proposition. We can expand it on phase 1 to up to 150,000 tons optional to our option, but it's not a mandatory contracting. So the strategy will be this blend of delivering to the off-taker and delivering to the toller. So the first shipment happens to the toller of LG Chem, which suits everyone. But again, we are able to confidently embark on a strategy also because our product is actually special in a sense where it does carry that 30% bonus of efficiency, which is not priced in, because our price is kind of the same price as a generic spodumene. There's no efficiency differentiation in this market yet, like you have in copper and iron ore and aluminum and all that, right? But so we are now very proud to say that we preserved our units, which meant we preserved our value, right?
Right. Now you mentioned exiting investments, and when would be the optimal time for A10 to monetize its shareholding? Is that being discussed at all?
Yeah, well, I love the asset, right? But I can't love it. This is the thing, right? So, again, very widely said that I'm a divorced mother of 2 children. So the only thing I own that I'm allowed to love and to hold are my children. Everything else is for sale. But ultimately, when you think about from a fiduciary perspective, my job is always to exit because I'm a guardian of this. I'm a private equity investor. Although delivering production is key because of what I showed you guys today. In other words, there was a repricing to take place of the company, and hence all the attention in our little company, because this repricing happens when you make first shipment. So we felt that it was our obligation to deliver that first shipment, to deliver that production, because it was a demonstration that this company made it, right? Deliver production obligation, which meant that, we're now going concerned producer and we're going to continue to march towards expansion. But as I said, from there onwards, then it would become, once we bridge the skepticism discount, right? Then it would become a regular conversation of present value. Differently than if we were a developer or had not bridged the skepticism discount by, for some reason, not delivering the material, not shipping it, we would then get into all this meandering, conversations that the developers have to. We wanted that out of the table because we can. We did it. We made it. We knew what we had. We controlled our project. We control timetable. We control production. We know, what downstream thinks of the product. We ran a demonstration plant for 3 years. I mean, remember, one important point, I didn't have a pilot plant on site. I had a demo plant on site. Demo means if I were to keep that little plant turned on for 24/7, I could get to 48,000 tons of spodumene a year. I just don't because of the cost, right? But this is sort of how we got so knowledgeable about this material we got. This is how we got so confident in embarking on this different business model of bypassing refiners and going straight into downstream, because we were able to ship hundreds of tons to downstream, hundreds and hundreds of tons over the years, right? Which no one had the ability to do in the industry. We did, right? Save for the producers. So we were in this quasi-producer status as far as downstream is concerned, because they tested, tons and tons of product differently than kilos and kilos, which is what they would do in a developer. So that confidence we have isn't blind confidence. I can't afford that because I'm not a junior company. I'm a private equity. I have a duty to my capital, right? To my shareholders in the fund and in the float. And ultimately, that's kind of how we did differently. So as I said, delivering production for us is, key. And after that is a matter of, we're going to keep on doing our thing, as always, marching towards expansion, right?
Yeah, and not all investors are skeptics as well. Can you maybe comment on the rumors about Tesla taking a run at you a couple of weeks ago, or rumors of a Chinese company taking a run at you?
Well, I think what's happening now is it's dawned on everyone that we're reality, right? So delivering, zero tailings, environmentally sustainable, socially sustainable lithium is actually a fantastic business proposition for investors, for the supply chain, and for everyone involved. I mean, we show the way in the industry. That's why I like to say we're a force for good, because we broke through the egg, and we, to make an omelet, you need to break eggs. We took the different approach. Being an outsider was actually pretty good because we took a totally different approach from the norm, and we made it. We showed it was possible. So I think all the attention is warranted because of it. And obviously, I mean, we got, quite a lot, several tons, hundreds of tons of uncommitted units, which, mathematically makes us an attractive integratable proposition. So I think very publicly, you see companies positioning themselves because it's kind of obvious. I mean, Sigma is held by a financial sponsor. We're delivering production, so we're going to be a producer held by a financial sponsor. My obligation is to exit. So, what else can I do? I'll continue to deliver on the business. I'm chief executive. I'm delivering expansion with kicked off engineering, detail engineering. I'm going on business as usual. But, some of these things are beyond my control. So I'm here to just perform the duties, the fiduciary duties of my job at that, chief executive of Sigma and partner of the A10 fund, right?
Mm-hmm. And do you think that all this attention is really a function of or a symptom of all the demand that's out there? Do you think that the largest lithium producer or buyers in the world are really concerned, possibly even panicked about security of supply?
I don't think there's a panic. I think there's a level of security because it became a chicken and an egg issue. And it's interesting when you look at the investments that were made following the green plans. They were very focused on the downstream. I mean, the first receiver of the benefit from the excitement with, EVs are now a real mainstay proposition were the downstreamers, meaning automakers, electric car makers. There was the whole spec frenzy on EV makers. Then the battery build up. So all the build up, all the investment was directed all the way downstream. Well, great. So currently, I mean, look, I just showed a slide about it this morning. There were 221 gigafactories in July 2021, basically going up, right? 221. But there was a disconnect with the reality upstream. So on that year, I think it dawned on the capital that that gap would have to be bridged. So all of a sudden, in 2021, investors moved on to upstream, but it was too late. Why too late? Because there was a investment gap built into the supply. I mean, I say this, lithium isn't rare. It's obviously not rare. It's like iron ore, it's everywhere, right? However, what is the challenge? You need to find lots of quantities, sustainable, high grade, meeting the spec, fast. Well, that's not fast, unfortunately, because the average successful greenfield to producer took what, 7, 8, 9 years. So this is the issue. We're suffering from this malaise of an investment gap that was just starting to be bridged in 21. Well, in 23, it won't happen in 2 years. So if you look at the forecasters, we got at least 3 years more to go until that capital that joined the industry in 21, greenfield, becomes production, right? Assuming no mortality throughout. So this is the moment we're in. And in the meantime, we got the automakers with these grandiose battery plans, battery factories, build up, incentives, subsidies, and they can't source material to feed all of this. So this is kind of where there's a lot of attention in upstream now, because it dawned on the industry that this investment gap created a situation where accessing supply, and it's interesting because there's an insensitivity to prices almost. What downstream wants is security of supply, of good quality, sustainable supply. And as a result, you have these movements of, several automakers now looking, with a different eye to upstream. And we were very fortunate at that because we happen to live this day, right? So for me, it's an honor and we have a lot of gratitude that we, there were times during these 6 years, and David, you followed it, when I thought there was no end. It was so dark, and we were like, Jesus, this is ever going to end, this down cycle, right? But it did end, and we survived to live the day when downstream finally worked out that without a fully integratable proposition, it would be hard to make it feasible for EVs to become a mainstay proposition, right?
Right. Okay. Just a couple more questions before we wrap things up. We've gone over on time, but do you have any customers for your residual lithium in the tailings? Essentially, is a lot of that material petalite as opposed to spodumene, and does that mean it's going to be really destined for ceramics or industrial users instead of battery users?
Well, no, it's actually spodumene, and that's the beauty of it. Because you see, when we chose dense media separation over flotation, we paid a penalty. What was the theoretical penalty? Because it turned out to be very theoretical, because flotation doesn't work that well at the end of the day. Theoretically, we would lose recovery. So our plant recovery at 5.5% concentrate is 7-ish%. Our overall recovery is 65, but that recovery goes where? It goes on the ultra fines on the tailings, right? Which we actually invested on dry stacking for the sake of environmental sustainability. And the plant technology we chose, which is dense media separation, does not utilize hazardous chemicals. So it is as if nature and the universe conspired favorably to reward us because we've done the right thing. In other words, we made the right environmental choices. We chose a technology that's environmentally sustainable. We sacrificed returns. We also sacrificed returns when we made extra investments to build up the state-of-the-art environmental circuits in a circuit that we pioneered. I mean, we're the only circuit out there for dry stacking in the industry. We had to crack that nut with the developer, with the equipment maker. And we have this beautiful dry stack tailing pile, which has lithium, 1.5% lithium spod, ultra fines, quartz, and feldspar, and it's got 12% moisture. So this is basically the spec of, a flotation byproduct, right? So we can actually sell that as main material. So the quote on this is very robust. It's very robust. I mean, it could be, north of $1,000 a ton. And it goes with the product. But more importantly for us, it's not about the money, it's about the fact that this gets out of the soil. So we have now zero tailings, which means, zero biodiversity impact, zero ecosystems impact. So for us environmentalists, this is a blessing, and it's fantastic that, a sacrifice we made became an extra source of revenue, because these revenues go straight into profit, it's ancillary, right? Straight into the bottom line.
Great. Okay. Right now we've got studies on phases 1, 2, and 3. They combine to create one of the largest lithium companies on the planet, 766,000 tons. What can you tell us about what you have in mind for phase 4?
We are working on it. It's open north, south, east, west. So we're probably going to publish the maiden resource, at some point around the summer. The priority now is basically production, and then put phases 2 and 3 into high gear construction. We're like literally, when you look at the chart I showed you, we're dead focused on reserve production cash flow, meaning, we're going to go in, we're going to enter that, production ladder, and we're going to build the expansion, because the market is there. I could easily place 766,000 tons of concentrate today if I had it. I don't have it. So we're rushing to have it, right? So again, the resource, the phase 4, why am I not worried about it? Because it's going to come on the back of things. It's not going to make a meaningful difference in my NPV, because that is going to the right word. That is going to enter into the back of my cash flows once the deposit of phase 1 runs out 8 years from now. So we got time. You know what I'm saying? So the way we see it strategically is all eyes on production and expansion. That's what's on our plate for the next 12 months. In fact, for the next 2 quarters, there's going to be quite a lot of news on that front. Right? Production expansion, and delivering, these quantities, and delivering cash flow, like sizable cash flows at that. Because with the prices the way they are, low-cost producers like us have this unique moment in time opportunity to achieve what we call excess returns. Prices are dislocated from long-term prices, obviously, right? They won't stay this way. How long? Nobody knows. So the concept here is to join this market while prices are in this excess return territory. This is why the rush, right? To 1, 2, 3, basically.
Okay, and last question, and I apologize for everybody that I didn't get.
It's super exciting to be here with everyone.
We've had so many questions here on this call today. We're going to try to download them and send them to you. But anyways, on that expansion, any plans to build any downstream infrastructure, such as a plant to produce lithium carbonate, lithium hydroxide? Maybe not even just producing from your own but from other mines in the area?
No, absolutely. And again, a year from now, when we talk about, upcoming phases 2 and 3 production, the question I'm going to get is what I've been getting from my own investors already. What are we going to do with all this cash flow, right? So most likely, once we go through this next, phase of construction, which is essentially is the same construction crew, by the way, we're just keeping everybody on site, right? For an 18-month-long project, right? We are going to be thinking about intermediate chemicals. Why intermediate? Because it's the easy chemicals. In other words, chemicals have 4 boxes, 2 of which are intermediates, 2 of which are specialty chemicals that today are pretty much 95% done in China. It requires a huge degree of expertise and a longer certification with cathode makers, battery makers. Now, the first 2 steps are kind of streamlined. It's basic chemistry, and Brazil is an industrial country. Brazil never deindustrialized. We have a huge industrial park. We make cars here, right? So we would basically, it's a kiln, it's a calcinator, and it's a sulfuric acid wash. So very straightforward, basic chemistry processes. And the knowledge and the human capital for that is widely available in Brazil. So we would then deliver that. That would be lithium sulfate if we were to follow what we call the delivery of the pre-hydroxide, right? Another flow sheet we're studying that could potentially be an alternative is what we call technical grade carbonate, because you preclude from sulfuric acid. So we're actively looking at what we call chemical intermediates flow sheets, because that's the viable one, to the extent that even if we were to build a super hydroxide plant, it would take us a while to certify it. So we would be running that on technical prices anyway until we certified battery grade. So we felt that, classic Sigma style, under promise, over deliver, like let's do one thing at a time. We would then next intermediate chemicals. We would choose carefully which route we want to go, technical grade carbonate or lithium sulfate. And again, we will be the best at it. Why? Because we'll be able to deliver a full waste solution to the Northern Hemisphere and to China, meaning we would then ship chemicals without basically sending the waste issue to the US or Europe. Because for the US or Europe to fulfill their refining ambitions, they would need to come up with an environmental plan for 12 tons of waste, sulfuric acid waste, for every ton of chemicals, which is kind of hard to do in these jurisdictions. What happens with this waste? What do we do with it in Brazil? We upcycle it, we reuse it in the cement, concrete binding industry, which is exactly what China does. In other words, Brazil, it's kind of the bellwether of industry in South America and Latin America, and it delivers cement concrete materials to the whole region, just like China. So you need a large construction industry, and you can absorb all that waste. So we would do zero tailings as well. So it's amazing. Right. And we can do, most likely, low carbon the same way we do using insetting carbon credits like we're going to do with Sigma, right?
Right. Okay. Well, Anna Cabral-Gardner of Sigma Lithium, thank you for joining us today.
Thank you, David. Thanks for hosting me. And thank you, everyone, for watching our presentation. It's a delight to be here with you today.
I echo that. Thank you, everybody, for tuning in. We will make a video of this, and it will be available on the Red Cloud Financial Services, redcloudfs.com site. Red Cloud Securities will be back on Thursday when Tim Lee sits down with Blackstone Metals. So that's March 23rd at 9 a.m. Eastern, and note that early time. So 9 a.m. Eastern. Have a great day, everyone. Thank you again, Anna.
Thank you.